In today's video, I want to talk about fixed income, as you can see here, but specifically I want to talk about the impact of interest rates. Now, there's a lot to be said about interest rates. It's probably a whole nother video in and of itself. But we all know that interest rates are low. For example, the mortgage that you're getting on your house is probably the lowest that you'll ever see or will ever see in our lifetimes. And that's a good thing. But what does that mean for a fixed income portfolio and low interest rates? What does that mean for our portfolio going forward? So let's dig in and take a look. Now, first of all, let's just remind everybody what is a bond. It's a form of fixed income that essentially is a contractual agreement that has a coupon payment, which is the interest that you receive, and it has it over a specified period of time. We call that maturity. So to give you an example, you might have a bond that has a 5% coupon interest payment, and it matures in 20 years. So that'd be a 20-year bond. Okay. So the other thing here, as we dig in, is this has some critical impact on both savers, retirees, as well as investors, right? It creates some unique challenges because of the expected return that fixed income has. All right, so let's just take a look at the relationship between interest rates and fixed income. Now, before we do that, I'm going to just take us back, 50 years to a chart of, I'll just put it here, the 10-year government bond. Okay, we call that the 10-year Treasury, or for short, the 10-year. All right, so if I go back to 1980, interest rates were up here at about 15%. All right. Fast forward to 2021. As of the close of business today, 1.65%. That's a pretty dramatic change. That's also a pretty long time frame. So if we just look at this and we look at what does a 15% 10-year Treasury mean? Well, it means your mortgage rates, which are based off these, going to be a lot higher than what it is now. It's going to mean what you're paying for a car loan, credit card payments, those types of things. They're more expensive when interest rates are higher. This is also a result of inflation being high, which leads to higher interest rates in an attempt to offset inflation. Now, inflation's really low, and we've seen interest rates over the last 50 years come down. Again, now this means mortgage rates are cheap. As I said before, car loans are cheap. Credit card rates are cheap compared to what they were 50 years ago now. But if we take our investment portfolio and look at how we have that allocated, getting 1.65% on money that you need to live on, say in retirement or for future goals, that's a pretty low rate of return. Now, we did another video on opportunity cost and what it means to look at sort of two different investment options, and I'd invite you to check that one out as well. But let me just get back to the point here. I mean, if you had $1 million invested in a 10-year Treasury right now, you're going to get 1.65%. That's about $16,500 a year. Pretty tough to live on that. And $1 million is a lot of money. Okay, so it's forcing people to invest in other areas. Now, I want to just say if we looked at the long-term average, and I'm just going to say it's around 5% of bonds. Let's take a look at if interest rates move from where we are now to the long-term area, what that might mean for a bond or fixed income portfolio. And I'm going to do that with just a quick little graph chart. All right. So let's take a quick look at how interest rates are impacting our fixed income portfolio. And I'm going to do this with just a quick graph. First of all, let's say we have a bond, comes out 1,000. It has a coupon, which is essentially the interest or income payment you get of 3%. It therefore yields 3%. Now, what happens if interest rates go up to that long-term average from 3% to 5%? If new bonds are coming out at 5%, is anybody going to pay you $1,000 for 3%? Well, probably not, which is what forces these bonds to go down in price. In this case, it would be about $845. we call this a discount. Okay? Forgot the U there. So the original bond at 3% is now trading at $845 because they have to be offered at a lower price to become competitive with new bonds that are coming out at 5%. So if we pay less for 3%, then effectively our yield is, pretty close to 5%. There's a calculation that goes into this, but I'll leave that for another video. But what if we reverse the roles? What if interest rates stay low and continue to get lower? Now, there's not a lot of room left there, but let's say they do. Interest rates go from 3% to 2%. New bonds are coming out at $1,000 at 2%. Okay? Now, is somebody going to pay you $1,000 for 2% when they can get the original bonds at 3%? What's that going to do to these bonds? It's going to make them more valuable. So now the price of these bonds go up, and I think we calculated a move like this would be about $1,089. And now this bond is trading at a premium. Okay? So I know there's a lot of numbers here, but the key takeaway here that I want to get at is, when bonds come out, if something looks better, then your bonds become less valuable. If bonds come out at 3% and new ones look worse, well, your bond's going to look better, okay? And that's the competitive nature of interest rates. So remember that chart we just looked at that showed 17% versus, 15% back in 1980 to now at 1.6%? There's still a little bit of room left on the downside to zero, but if we trend back to our long-term average, which at some point we may, then you just need to be careful because the value of your bonds may actually decline in price. Now, they're still going to pay income, okay? But the risk is that you've got money invested conservatively, you've got predictable income from it, but if interest rates shift and all of a sudden the value is worth less, and you have a medical issue or an unforeseen expense, it could be small, it could be large. The thing about those is that they're unforeseen and they're unexpected, and you have to liquidate part of your portfolio that's in this at a lower price. That's not a good thing, right? So I think the key takeaway here is I want you to go back and look at your portfolio, talk with your financial advisor, and kind of look at that balance of investments that you have. And you could start simply with how much do I have in stocks versus how much do I have in bonds. And when you do that, then you'll kind of get an idea of how much of your portfolio is impacted directly by the move in interest rates. And it'll give you some context about what could happen if rates increase back to their long-term average, which could cause some of the values of those portfolios to decrease. So I want to make sure you got a heads up on that. If you enjoy the videos, make sure you subscribe, and we'll see you on the next one.